Now, before we get into the next segment, I'd like to remind you, please like, share, subscribe. Your comments are appreciated. Let us know if there's anything you want to hear more about, anything that we can do a little bit differently. There's a lot, obviously, to discuss, especially on the macro level. And then in the EIA show, we're going to try to tie that back to energy and why we think that's going to impact, that demand segment. But, when we look at where is the emerging market, so asset allocation, I think, is obviously an important view of not only just where the dollar is, but also how people are really kind of looking at the market in general. And here you can see that the when you look at January 2021, we have a massive expansion of asset allocation into emerging markets, and they're currently at all-time highs. And the question is, how much of this is just, okay, well, there's going to be growth here because they're doing better than developed markets in terms of COVID. They're going to continue to get support. As we see developed markets recover, emerging markets will get an outsized proportion. Or how much of it is just a seeking yield, seeking some sort of not only carry trade, but also in a way to get into something that has a higher earning or yielding side. And this is going to be something to watch, as we've seen some pretty, let's just say, solid drawdowns that have happened very quickly when we get into such extremes, which is, again, going to be something to watch. But when we look at emerging markets and how they spent, and this is something that we've talked about in the past in general. When we look at Brazil, obviously Brazil has done a lot. We've had change in real primary spending in January through November as a percentage, but it still remains fairly soft in terms of what has been spent. And I think India is a bigger one to look at in terms of what some of the running room that they have to continue to stimulate. And when we look at the U.S., so real primary spending change in January through October, November, in percent, central governments alone, you can see U.S., Canada, Deutsche, when we look at Brazil, Britain, Italy, you can see a huge amount has been spent in just the developed world, where an emerging market average, you can see it's well below. So the view is, okay, well, emerging markets didn't increase their debt as much, so there's going to be more running room as we start to see some more stimulus, so this is going to be beneficial. So you can start to make sense of why people are putting so much money into the emerging markets. I tend to think that can be concerning, but obviously China's a huge mover in that, where if you look at the FXI, I mean, it's up another, 5% today as Jack Ma made an appearance. Let's see what it's up. So 4.5% right now as we look at where things sit. And again, these are things that have continued to go over the last 2 days as the FXI continues to push towards extremes, and emerging markets in general continue to be the favorite in general. And this is part of the reason why. So let's just look at one of the most famous streets in the UK. You can see as we came out of lockdown how you had a big increase in footfall, and the recovery was there. But now we're at a big drop overall. And here you can see the issues in general as we start to see some of this slowdown. And again, we're not getting back to that holiday surge. And it leads to, because there's obviously tighter lockdowns, but also there's just people looking to do less. And there's just this pain that is going to continue to hit into the European market, which is why the ECB is going to have to do more, which is why we look at the euro as a bigger driver to the US dollar versus just the US, the fundamentals of the US dollar in general. What is the euro going to do, and how is that going to impact that other side of the trade? Because when we look at mobility in Germany, workplace, transit, retail and recreation, again, all of these are at really significant lows as we consider how things sit coming out of the holiday. We're just not seeing that same type of recovery as people are doing less in Germany. Now, there's some offsets to that, which we'll talk about in the EIA show, where trucking miles are up. That's a positive in general. We're seeing some of these benefits that in some parts of the economy. But on the consumer side, we continue to see that slowdown as people did as much as they could prior to the tax snapback and this uncertainty as to, well, this is Merkel's last year. What's going to happen to Germany on the outset now that she's going to, go sail away into the sunset, and what's going to be the direction of not only the government, but also her party and the country in general. And those are some of the unknowns that I think is going to start to appear. Now, again, when we look at workers receiving state wage support in December, 915,000 business-related, 583,000 manufacturing. This manufacturing side is going to be a big piece because exports have continued to be strong. When we look at some of the trade balances and the current accounts in general, Italy came in a bit weaker versus where they were in October. And again, that's something that's going to continue to weaken the overarching numbers. But Germany so far has been able to maintain some pretty stable manufacturing. And it's come with some government support, but not as much as other areas are going to continue to need, specifically Italy, France in general, because construction output, when we look at, let's look at the Eurozone in general. So in November, construction output year over year was down 1.3%, but construction output month over month was up 1.4% versus 0.5% in October. The issue that we're seeing, back to the commentary from the muted economy, when we're looking at Germany, that we had a big drop off by the end of December and weakness into January. So while that is good looking backwards, when we look forward, and then coming full circle back to the first segment, when we looked at high frequency data, mobility data, that weakness is really starting to creep into the system and into the economy, which is going to be impactful in not only just January, but also February, hurting some of these leading indicators. And then when we look at contributions to real GDP growth, looking in Germany specifically, again, private consumption continues to be the problem. So, and then now just coming across, Italian parliament approves extra deficit spending up to 32 billion euros. So again, more stimulus. So when we look at contributions, this is where those contributions have to come in, because public consumption, construction investment, those government driven things in that 2020 level, that's going to continue to increase as we look into 2021. And Germany is already expected to increase. Italy is now approving those increases as private consumption, investment, inventories, net exports, remain on that negative side as we go through the year, not only just year over year, but also into Q1. And the core inflation. So again, this bifurcation where core inflation, so U.S. has seen an uptick. The BOJ saw that started, the Eurozone, the BOJ started to see that decline. But now Bank of Japan is something separate, which we'll talk about in the next segment. But when we look at Europe, again, it's going to be a matter of what is happening in Europe overall, between where is the money being deployed, how are people spending. Where people spend money, those prices are going up. Where people don't spend money, those prices are going down. So when you blend it together, it looks like there is a benefit to the consumer, but there really isn't. They're not seeing that benefit. So even though we're seeing these numbers, it's not being pushed to the actual underlying economy consumer, so they're still doing less. So when we look at the GDP calculation and start to assume or calculate what the consumer is going to do, we continue to come in with some weak numbers, and that's going to continue and really kind of drive Europe in general into that double dip recession that everybody fears. And then when we look at, the trade weighted side, so when we look at those trade balances coming back to where things are going to fall, so the trend in the European zone, the trade surplus won't be sustained, because you're going to see that right sizing where PM trade weighted euro, that inversion is going to weigh on just, again, the cost of doing business with Europe, which is why the euro coming back to how are they going to try to soften some of this exchange rate, incentivize some of this trade. And that's going to pull down some of these Eurozone trade balance, which again is going to hit the economy overall when we look at that trade surplus that's going to go away. And now this is more of a British exit side. So when we're looking at the labor market trends are suggesting a larger emigration of foreign-born UK residents, You're seeing people that are just what the estimates were of the movement out of the country, and now what the actual estimates are showing to be in terms of where things are for the Q3. London is obviously a big one, but we're seeing those estimates were close in some areas, specifically southwest, southeast. It's just they're starting to get a little bit trending higher, but London is going to be the biggest loser when we're thinking about people leaving those areas and that emigration away from the UK, driven by some of these key factors. Now, some of the bright spots, because we've talked about Turkey, and Turkey has seen some benefits, especially in the industrial production side, where they've surprised to the upside. The survey was 10%, they were up 11%. This is going to be an interesting one as Turkey tries to right the ship, and they continue to see some of this robust moves in some of their data points on the emerging market side, because again, there are some benefits like Korea, Taiwan, Vietnam, Poland. Poland is one that's going to be more of a longer term play for us. But when we look at Southeast Asia and some parts of Turkey in particular, those are areas that we think are going to see that, or going to continue to see that outsized growth. So even though there's some concerns on the emerging market side, there are some bright spots and ways to play that long and short component, where Turkey is one that's not one that they still need to kind of prove themselves. Obviously, they've done a very good job with that recovery over the last quarter or two, but we need to see that continue, or if there's going to be an adjustment as those COVID cases rise and that pain continues to mount overall. And then when we look at, again, the issuance. So yes, when we think about what have emerging markets done, but let's look at where is the issuance overall. And here you can see the weighted average coupon has fallen to, let's call it 4%, but the amount of time. So we've gotten a little bit more of that duration side. So the tenure, the weighted tenure is increased to about 12 years, while the coupon has come down to about 4%. So again, it's a duration play. So is there going to be risk? Maybe not in year one, but in year 3 or 4, if we get this slowdown in the recovery. But the extension is there, and it's at a much better interest rate, and it's at a higher amount, where now they're issuing about 225 billion at an average rate, at an average duration of 12 years at 4%. That's a pretty good backdrop. And if you think about rolling short-term into long-term, the question is going to be, where does that debt go over a 5 to 12-year period? If there's an inflation fear, if we continue to see some of these inflation concerns, going through the system, and what does that 4% become? And as they move away from par, start trading at discounts, where is that movement going to be? Because obviously the yield has been so important, because let's just say people have struggled on a lot of different levels to find yield anywhere. And emerging markets were very smart to say, look, the European Union, the investors there, that they need yield, so let's denominate our debt in euros. Let's go capitalize on some of this market. And that's where we've seen some of those yields come down, because I can either buy Italian, German debt negative, or I can buy Turkey at 6%. I can buy, some Taiwanese bonds at 3.5%. I can buy Korea at 2.5%. And you're starting to see how that works into it, and that's where, and they're taking advantage of length and time and that cost. So again, these are things that will be beneficial for emerging markets, and these are things that we're constantly weighing in terms of how overextended is the trade, but how much support are they going to get from the back end. So these are things that we're going to continue to look at. And now in the next segment, we're going to go deeper into China and what does this mean for Chinese investment, and what are some of the GDP numbers mean, and what is that some of those rejiggered or smoke and mirrors, as we call it, as we try to sift through some of the noise to find some of the real data that we think is going to be meaningful as we head into the second half of Q1 and then project into the rest of 2021.